All right, the meeting is now being recorded. So these are the sectors we trade with options. We only trade ETFs, not stocks, since we only buy calls and puts. If we do it with stocks, then implied volatility becomes a really big issue and time decay. We don't see those same issues with the ETFs as far as implied volatility goes. So when we buy an option, if we buy a call and we have a profit objective, once it gets to that target, when you do it with stocks, quite often there's so much time decay, you end up losing money in the option by the time it reaches your target. We don't have that same issue very much with the ETFs. So that is why we like to trade the ETFs with pure directional trades as buying calls and puts. And a little bit later, I'll show you some of the numbers that are attached to that with real dollars and cents from one of my coaching clients who had made his live trades public. And he actually did a presentation on it showing his live trades because he was so proud of his results because it really turned his trading around. So we'll show you real numbers a little bit later on, so you have a good feel for how money is made and how much money is made. So it's quite common that people tell me, when I'll ask them, okay, if you have a $100,000 account, how much money do you expect to make from that trading options this year if you are starting out with $100,000? And literally half the people tell me, well, I can make anywhere from 200,000 to $500,000 starting with 100,000 in 1 year. No, that is not realistic. Can you do that? Yes, it's called gambling, risking big, all or nothing. And you don't hear anything about the people who lose all their money. You'll hear those one or two people who made it big, they hit it, they just like, bam, hit it, and they got lucky. And then they can just as quickly lose it. So we don't look for that type of thing. We look for consistent annual returns that can range anywhere from 15 to 40-something% return on account. Okay, that's how we trade. Usually people contact me for help as a coach after they've lost several $100,000. I'm not even joking about that. People contact me after they've lost several $100,000. One person took an account worth tens of thousands and took it to $1 million, then lost $1 million because they were under the impression it was through their trading skills that they made $1 million. It was in crypto actually, and they made money because the market went up and they just happened to be long. But when it came down, they realized their same trading skills just kept losing and losing and losing. And they realized it wasn't their skills that made them money. They just happened to be lucky and the market went up. So that's when they come to me, when people lose their money. So it's good to get help, get guidance before you lose the big dollars. Okay. It really does help a lot to get a starting point where you know you're going to make money. It just has to be consistent. Listen to your coach and you'll see the numbers work out in your favor. So anyway, these are different sectors we trade. So it's a very diversified way of trading, whether it's emerging markets, China markets, real estate, NASDAQ, treasury bonds, basic materials, energy sector, financials, industrials. So we trade the full spectrum of sectors. And we use a similar type of approach. So today we're going to be looking at 1 out of 6 strategies which we trade. Some of you have seen it in the past, but we're looking at 1 out of 6 strategies. But I usually start out meetings by So question, isn't ETF trading slower and lesser gains than actual stocks? If you want to trade, if you're looking to make money consistently, great, you trade ETFs. If you're looking for gamble and hope for a big win and a buy and hold, not options, not options. Options expire, okay? You have to have a plan with options because every day you hold an option, it's losing money. So the big gains are not applicable if you're talking about trading with options. If you're talking about buying a stock and hoping for the best it goes up, yeah, it'll have big gains. but you won't be in the option because the option is going to expire well before the thing goes up for a couple of weeks or months. And even doing spreads on options on the stocks, then you are extremely limited. Spreads limit your ability to make money. So if you're doing spread trading on stocks, your ability to make money is limited. If you're just buying the stock, then it's unlimited in one direction. But you can have huge losses, literally you can literally lose half your money overnight with stocks if you just buy the stock. So what we trade is business. It's looking to make money consistently. If you have, let's say, 100 grand account and you're looking to pull down a 20 to 40 to 50% annual return, we do that very consistently. Not gambling, hoping you got the right stock, because the market can be going up, 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 but a stock can be going down, 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 down. So we don't bet on one stock, we bet on a basket of stocks. So we don't have to deal with all that volatility of one stock, and then we can just buy calls and puts. And it's just smarter trading. If you're looking to gamble, if you want excitement, then trade stocks. If you're looking to make money consistently in a business-like manner, trade ETFs. That's really the big difference. So ETFs trading slower. I don't know if I'm not sure what slower means. Anything we trade it's moving. Whatever you see in the market happening, it's happening in the ETFs. If the market's down 1,000 points, that ETF is down 1,000 points. So it's not really slower. It's just less destructive to your account when it goes against you. That's the difference. It's just less destructive to your account. All right. So I'm going to switch over to a long-term chart and take a look at the big picture before we get started. And let's see. You share. Okay, what you're looking at right now is a monthly chart of the S&P 500. And when I say monthly, every candle is 1 month worth of time. Every candle is 1 month worth of time. Here we are back in 1999, 2000 time frame. This blue line is a monthly 40-period moving average. Nothing but a 40-period moving average on a monthly time frame. Okay. So this is, like I said, the 2000, 2001 time frame, market crashed. What we usually see is if you get 2 consecutive monthly closes, lower closes below the monthly 40, you can expect this market to go lower. So that's kind of a guideline, something learned from different people in the business, looking for 2 consecutive monthly closes below the monthly 40-period simple moving average. If you see 2 consecutive monthly closes below, good chance the market is going lower. So here's the 40, here's that 2001 crash, and then this is 2003, we're back above the 40. Okay, so years go by, and every couple of years, the market will pull back to the 40 for support. Okay, this is the 2008 debacle when the market crashed. 2 consecutive closes below the 40, and the market went lower. Okay. During this time, normal pullbacks every couple of years, it has to pull back to major support, just the way it is. These are all months. These are years going by in an uptrend. 2 monthly closes below. And this is 2008, 2009. It wasn't until 2010 we're back above the 40. And we've been there since for the last 12 years, basically. So it'll go up, up, up. And during this time, this is several months pulling back, and everyone in the news will tell you the market's is going to be 2008 all over again. The market's going to crash and drop 50% and the whole deal, the sky's falling. No, it's going to pull back to monthly support, and then you wait and see what happens after that. Pulls back to monthly support and takes off again. This has been the biggest single uptrend in market history in the last forever. Every couple of years, it pulls back to the 40. During these months, there are going to be times when they're telling you, Once again, it'll be a 1,000-point down day, and they'll tell you, once again, everyone thinking that they're going to lose all their money in the market. It's like, go to cash. Everything is like, what do we do? You'll hear all these people, are we going to lose our 401ks? No. It pulls, we're in a massive, massive uptrend, and every couple of years, the market pulls back. This is called a major buying opportunity. Okay, so when we see the pullbacks, instead of when you have see the big picture, you don't get afraid. You have to understand the big picture and look for opportunity, not fear. So those who understand this big picture see, yeah, baby, we're just waiting for those buy signals. As soon as the price gets down to those levels, we look for our buy signals on our strategies, and we know those are very, very high probability trades in our behalf and going our way. So when we see that, anyone I'm coaching sees this happening, we know it's just like, we're just waiting for those buy signals. As soon as we see a buy signal around these levels with our strategies, I'm like, yes, perfect, perfect. All right, a couple of years go by, massive, massive uptrend. Okay, we're in 2018, market pulls back, right down to support again. People will start freaking out. It was like the sky is falling. Everyone, save your. No, it's just normal market pullbacks to support every couple of years. This was 2020 when everything shut down during the pandemic. This was 3 whole weeks. For 3 weeks, the market pulled back below the 40. Now, if there was a second consecutive close below the 40, I'd have a concern it's going lower. But it immediately rallied right back above the 40 the next month, and we're right back in our trend. And this was when everything shut down. During this 1 month, everything shut down, and this was probably our 2 most profitable months of trading, because we had our sell signals way up here on the daily charts. And it got to a point where we ran out of sell signals. We literally made so much money, even at the first target. We were having our options double in value adjusted for our first profit objective, because it was so volatile. As the market made such big moves, we just made massive money on those trades going down. That's why we have setups that buy bottoms and short market tops, and finding market tops and market bottoms is not that hard. Just that the people who know how to do it don't want you to know how to do it. They want to sell you trade signals or their services. And my point of view, I believe in teaching you how to find your own trade signals and how to manage your own positions and your own trades and your own money. Okay, you don't need someone to tell you where the market is, where the market's going to go up or down. It's not that hard. All right, market's continuing, still a massive uptrend. This was where we are a couple of months ago. The market came down below the 40. You can go back to my postings in the last few months. This was at my previous meetups when we looked at this. I said, this is the time of year when we expect the market to be bullish. So I was looking for the market to get back above the 40. And it did. The very next month, this was October, it came down in September, closed below the 40. If we had a second consecutive close lower, okay, it's probably going lower, but it went right back above the 40 in October, right back into our uptrend. Perfectly timed for the end of the year seasonal pattern, which we expect. And here we are right now. It's a similar thing for the NASDAQ and Dow. Okay, massive uptrend. Nothing's changed. Same as it's been for the last 12 years, massive uptrend. We just have to pull back to support every couple of years, just normal trading. But when you look at the big picture, then you don't freak out. Day to day, there's going to be lots of volatility and noise from day to day, because the reality is, if it could take 2 years for the market to go up this much, but it could take a whole lot less for the market to come down that much, okay? So markets come down a whole lot faster than they go up. But it's just normal trading. And how that was explained to me is that institutions acquire positions over time when they want to get long. so they can get the best price constantly going up. So it's a slow process with institutions acquiring positions over time. So you see trends gradually increasing. However, when it's time for institutions to get out of positions, they get out of it quickly. So you'll see the markets go down a whole lot faster than they go up, okay? But it's like really no big deal. So I'm going to switch back to the presentation for a moment. Like I said, if you look in the, I'm going to put it in, link in there again. See, in the chat window is the link to the page on our website where you can find the handouts. So you can download the PDF if you'd like to. And I'm going to switch back to the presentation and see, where are we? Okay. So this is what we had looked at last time. This is a seasonal chart from, this comes from Jake Bernstein's website, seasonaltrader.com. And what we had looked at was this time from October through November, where this is the S&P 500 seasonal chart, and it shows a definitive trend. The market tends to have a definitive trend upward for 2 to 3 months from October through December. That's kind of what we look for in our seasonal charts when we want a definitive pattern, a 2 to 3 months period where there is a statistical expectation more often than not that markets will move in a certain direction. And when we looked at all of our trades during this time, we found any long trade we took from the middle of September until November was 97% winning trades. 97% winning trades on any trade on any long trade we established between mid-September and November. 97% of those trades were winning trades on the long side, about 87% on the short side. Significant difference in this period. And so far this year, this is exactly what we're seeing. We're seeing the long side is in play, and the short trades are still working out okay too, but the long side is definitely in play. And it looks like this year we are well on track, as I showed you from the monthly charts, to see this end of year pattern continue through December. And so all of our long trades are doing really well, and approaching targets, already have hit them. Okay. So we're going to look at one of the strategies we use to capitalize on the long side. And this is our Donchian crossover buy. So before we detail this, I'll show you how we do our trading plans. This is not a detailed trading plan. This is an example, so people can get a feel for what we give to you and then I work one-on-one with people only. I don't work with groups. I only work one-on-one with people. Found that's the easiest way to do it, for at least to get to real, because everyone's different on how they learn and how quickly and what needs more clarification. So we use setup, trigger, trade management, also 3 terms and a structure I got from Jake Bernstein. The setup is visually what you look for. The trigger is a confirmation that if you see the setup and you also have a trigger that day, then we have a certain statistical expectation of what will happen next, okay, and to what magnitude. And then we're going to be buying call options and then managing the position once in it. So we're going to have a very definitive entry criteria, and then very definitive exit criteria, and trade management will be, I work with you on that because of different ways to manage the trade, but the first target's always the same, how we do that. Stats, I put one example in here of XLB, that's the material sector, and all the valid trades that have been since the inception of the ETF, which was 1999. These are all the valid trades. This was last updated at the beginning of 22. I think there have been a couple more trades since then. But this is how we track the win percentage. This was 91% wins with 1 expiration cycle of time, and 2 expiration cycles, 94% wins. Expiration cycles is approximately 1 month of time is 1 expiration cycle, and 2 expiration cycles is approximately 2 months worth of time in the option. And we can go over that a little bit later on to define that a little bit more. But that's basically what this is. 1 expiration cycle is approximately 30 days worth of time in the option, and 2 expiration cycles is approximately 60 days worth of time in the option. And this is our win-loss percentage. Anything you see in little rectangles was put together by Becky. Becky maintains all the stats for everything. So that's how we know what to trade, because if it's under 84% wins, we do not trade it, we do not touch it. All right, so along those same lines, I want to show you some stats which I had Becky put together, and these spreadsheets are on my website also, so you can actually take a look there to see those in the same page that's in the chat window. I'm going to pull up the spreadsheet now and take a look at that, so give you a feel for exactly what we're talking about. So what do we have here are all trades from 2019. That's what's on the spreadsheet. Our actual real stats go back to 1999 and 2000. Some ETFs only got created in 2005, 2006. So we have the stats from 2005, 2006 to now. Some got created well beyond that. So we have stats from starting in 1999. I just had Becky put together stats over the last couple of years, so people can use it as a reference to get an idea for what to expect, and because it really doesn't change a whole lot, okay? But this is all of our strategies, all of our trades, regardless of win-loss percentage. It could be like 50% wins. It could be 30% win, doesn't matter. This listing is all ETFs, all trades, regardless of the win-loss percentage. And this is what we see between October 1st through April 15th. These trades are for October 1st through April 15th, just over the last 4 years. 1,078 trades. On the long side, 87% wins. On the short side, 86% wins. Okay. This is October through April. This is with all trades, regardless of whether they're over 84% or under 84%. You can literally take as many trades as you want and do really well, okay? We also have a separate sheet here. These are all the trades that were 84% or higher within that same period. So it's a subset of the previous listing, and I'll have a summary of those next to each other in a moment. But 808 trades, and the long side went up to 89%. The short side stayed around 86. Okay. So just by reducing our criteria to 84% wins or higher, we increase our percentage wins. Now I'm going to do this third sheet here, which is just a summary, which is easy to look at. So when we take every single trade, this is the number of total trade, long trade, short trades. But here we get into number of winners and losses. If we take a look at the number of long trades, we had 83 wins, 83 losses when we took every trade regardless of win-loss percentage, but only 50-something losses when we limit our trades to 84% or higher. Remember, with options, you need to guarantee you have a winning record, you need to have 4 to 6 wins for every 1 loss. So the fewer losses we have, the less wins we're going to need to offset it. So we do really, really well trading options, primarily by not having very many losses. we just don't generate that many losses. This year we had 2 losing months, and this 10 months have gone by. So we've had 8 winning months and 2 losing months. I think we're losing months. We had 2 losing months this year and 8 winning months. Basically, it's a winning year of option trading. Okay. So we always separate long from short, because trading long and short are 2 totally different things. But this shows you that when we limit our trades to 84% or higher, we do have an increased number percentage win overall. And that is what we try to look for and reduce the number of losses. The fewer losses, just on the short side, going from 64 losses down to 44 losses is huge. Okay. It might be the same percentage, but having literally the number of losses reduced, we don't need as many more winning trades to overcome them. So, and it messes with your head also, the more number of losses you have. So if you have fewer losses, your psychology ends up actually being better, because you don't have to deal with the negative. The more you can keep things positive, it's actually better psychologically. The numbers will still work out pretty well in your favor, but it just messes with your head. And we'll look at numbers a little bit later. All right, before we move on to take a look at the actual charts and the strategy, do we have any questions at all so far on anything? Feel free to unmute. If you raise your hand, I won't see it. So feel free to unmute and ask a question, or type it in the chat window. Either one's fine. Any questions on anything at all? Even if it's obscure and you're not really, ask it. Need to be clarified on anything. No question is silly, so feel free to ask anything you want. During meetups, my whole world is open. All right, so I'm going to pull up the chart, and we're going to look at one of the strategies. All right, so if you've seen this one before, we're going to do the Donchian cross. It's the one that's in the trading plan, the sample trading plan, and in the handout. Okay. I think all right. What you see on the chart here, this blue line is a 40-period simple moving average. You will see a 40-period simple moving average on just about every chart we have, whether it's on a daily chart, a weekly chart, a monthly chart, an intraday chart. A 40 is always on there. And I've been asked, why do we use a 40? The simple answer is Oliver Velez. Oliver Velez is a gentleman who we met at a Traders Expo years ago. And he had developed a whole bunch of strategies based on the 40-period simple moving average being an indicator of trend. And we started following what he was doing, and we put a 40-period simple moving average on all of our charts. And next thing you know, it became a staple in every strategy we use. Somehow a 40 is involved in some way, shape, or form. It might be a primary indicator of trend, or it might be something that's incorporated as a trigger. Okay, but a 40 will be on almost all of our charts in some way, shape, or form being utilized. This orange colored line is from the Donchian channel. The Donchian channel is an indicator, is a trend indicator. It has 3 lines, an upper line, a lower, and a middle mean line. What we're showing here is only the mean line. We do not use the upper and the lower. So they are basically been made transparent, so they don't just take up space on the chart. So I'm only showing what we actually use, which is the mean line. So this is the Donchian mean line from the Donchian indicator. So we have the 40 is the blue line, and the orange line is the Donchian mean line. This dotted line is a Bollinger Band. This is just the upper Bollinger Band. Once again, a Bollinger Band is 3 lines, the upper, middle, and lower. We're not using the lower or the middle Bollinger, so made those lines transparent so they don't take up space on the chart and just clutter it up. So here's the Bollinger Band, upper Bollinger Band, Donchian mean line, and a 40-period simple moving average. Now, I need one or more people to grab a calculator because I'm going to be asking you a question that involves some numbers. So someone get your calculator ready because I'm going to be asking you to type it into the chat window, some simple calculations. All right. So this strategy is pretty straightforward. Okay. So it's a very visual thing. The setup is a visual recognition of something. And if you see the setup, then you spend another moment or two to find a trigger. All right. Here, did the orange line cross the blue line? No. Next day, did the orange line cross the blue line? No. No. Did the orange line cross the blue line? No. Yes. Did the orange line cross the blue line? Yes. That's our setup. That's literally all we're looking for. The people who are programmers out there can write a program to look for that. The people who are not programmers, it takes seconds. Oh, yeah, the orange line crossed the blue line. If you take a look at the data box, this is NinjaTrader, which we use for analysis. So, but here's the data box on the left side. If you can't tell with just your eyes, you look at the mean line, the value is 333.55, and it's higher than the blue line, which is 333.01. So we had a crossover. Sometimes it's too close to tell with your eyes. So you look at the actual values and you see it crossed over. All right. When I see this crossover happen on, this is the Qs, the NASDAQ. I know because we have this a sheet with all the stats, the win-loss stats for every ETF, for every strategy. And I'll show you that in a little bit, an example of that. I know that when I have this happen, that I now know I have at least an 87 to 90-something% chance probability that this market is going to go higher in the next 4 to 8 weeks by at least one ATR in value. The ATR is average true range. It's how we measure volatility of the underlying ETF. We do not do analysis on options. We do analysis on the ETF. We use the options in place of the instead of having to buy the ETF, we buy the option because it's a whole lot cheaper and it has leverage to it with limited risk. So you don't need as much capital. With a lot less capital, you can get a much bigger bang for your buck, so to speak, and with very limited risk, okay? But you have to know how much time you need in the option. This is not just random guessing. There is no guessing here, okay? Everything we do is statistically verified and repeated over decades. It works, and we have, if something happens, when this happens, we have enough history of all various ETFs to know what's going to happen next. So this combined with, so this is a setup, and the trigger is how many days this orange line is below the blue line. That's part of the trigger to confirm that. If it's chopping up and down, up and down, up and down, above and below, we don't take those trades. It's too choppy sideways. So this has to be below, orange line has to be below the blue line for a certain number of days before it crosses up. And we don't take trades which are closed above the Bollinger Band because the next move is usually down. So we don't take moves that are really extended over 2 standard deviations above the Bollinger Band. So that's to close below the Bollinger Band, and we take the number of days. Okay. So on this day, the indicator is actually on the chart at the bottom. You don't need to see the line, but the data is in the data box. So on this day, the ATR is $3.71. It's telling me on June 10th, 2021, on average, and with the 5-period ATR. So every 5 days, the Qs is moving approximately $3.71. Okay. So that is how big a profit objective we are going to seek on our trade as our first target. So we're basing our targets on the reality of how much the ETF actually moves, not just us making up random values. Well, I wanted to move 10 points. Where do you get that from? You can't just make numbers up. That's ridiculous. That's how people lose all their money, just gambling. Yeah, it's going to go up forever. No, it won't. And if it's going to go up forever, it's going to go down first, and you're going to lose all your money because your options will expire worthless. It's going to expire worthless, then go up. So when it comes to us buying options, you better have a plan, or else you're going to burn through a lot of money really fast. Because even if you're right, your option can expire worthless. You lose all your money, literally 100% loss of your money. Then the market moves your way because you had the wrong choice of options and time. That's why everything we do has a plan to it, and especially how much time in the option. And then when I work with you one-on-one, also how much is too much to pay. Sometimes you have to pass because options might be a great trade, 98% winning trades. However, for that particular trade, the option is just too expensive. Wait for a better time to get in, or wait for better opportunity. So, and that's what I go through now with one-on-one people when I'm working with them. So on this day, the option is 371, I mean the ATR. The next day, the market opens at 340.36. So now I need someone to do the calculation. The open that day, the next day is 340.36. Someone write that down, 340.36. Open is 340.36. The ATR the previous day is $3.71. What is $3.71 added to 340.36? So what is $3.71 added to 340.36? Please type that in. Anyone? Okay. 344.07. That is going to be our first profit objective. Okay. So how this works now. The next day, when the QQQ is at or below the open price, at or below. So it opened at 340.36. Let's say we get in right at the open. We're going to be buying the first in the money option, which is, and there's an option at every strike. So we're buying the 340 call option. Okay. And that's going to either be July or August option, because one expiration cycle, two expiration cycles. All we trade is the third Friday of the month expiration. We don't do any of the ones where the weekly options expire in the first week, first Friday, second. We only trade the third option that expires the third Friday of the month. That is the option that's been around forever. All those other ones, those weekly deals, have only come into existence over the last 15 or so years. We don't trade new stuff like that. We trade the one that's been around forever, which is the third expiration, third Friday of the month. That's the only expiration we trade on any strategy. Okay. So the target lawyer calculator is 344.07. So you're entering the trade at this open. The next day, it went as high as 344.52. So you entered today. The next day, your first target is hit. A quick move like that, you're looking at a 20 to 30-something% return on your money in one day with a quick move like that, depending on whether you chose one expiration cycle or two. It's going to be a 20 to 30-something% return on your money in one day. Are you going to catch this big move up here? No, because you're going to hit your target. You're going to, let's say you have multiple contracts, you put your stop in a remaining contract, but the next day it pulls back and stops you out of the remaining contracts. But we have other trades that happen throughout this whole move, which we're not going over today. We're just going over one strategy. Okay. So that would be an example. Let's take a look at something very recent. Orange line crosses the blue line when, let's see, orange is 273.86, so it didn't cross there. Here, orange crossed the blue line This happened on 11/14. You're entering the next day at or below the open. So here is when the trade was valid. The ATR is $8.27. With big volatility comes big potential profits, but you also need a bigger account. So the benefit of that list of ETFs we have, there's always something for everyone depending on their size account, because this is one of the quote unquote the bigger size dollars involved, because the option is going to be running over $1,000 for one contract, well over 1,000 for one contract. But there are other things you can trade also that are less expensive, but Qs, I always like Qs because it works well on everything. But let's take a look at this. ATR 827. Someone write down the number 827, $8.27. The next day's open is 292.21. Next day open at 292.21. What is 292.21 plus $8.27? So at $8.27 to 292.21, what's that value? ATR, okay, 300.48. 300.48 is right around here. That's our first profit target for this trade. Depending on your decision making, this option will either expire in December, the third Friday of December, or the third Friday of January, depending on which you chose. Just so you know, all the stats we publish for wins and losses is based on making conservative decisions. It's based on having 2 full cycles of time, which is basically at least 60 days of time in the option. If you go shorter, there's a lower upfront cost, but it also has a higher probability, not a big probability of failure, but a lower probability of success than having more time. So you pay extra for the more time, but you will have fewer losses. So we usually prefer fewer losses and have a little more upfront costs. It feels good for us. What's the stop loss? The stop loss is what you pay for the option, 2% of your account max. Do not risk more than 2% of your account. That is your stop loss. If it goes 1,000, if it goes 10,000 points against you, big deal, you can come back. 2% account risk per trade. That's the benefit of using just calls and puts. So if you have a smaller account, it's almost guaranteed you will be risking more than 2% of the account. Guaranteed, it'll happen. But you want to get to a point where you're only risking 2% of the account and not more. That is the sweet spot. If you want to go 3 and go crazy, okay, 3 and go crazy with 3%. But you can never have a big loss, because I know some people, they don't think about what if things go wrong. They always think about how much money I can make when it goes right. And I believe in focusing on what if it goes wrong, right? Because we have to think about our losses. No one ever talks about their losses. We got to think about our losses. We're getting 80-something% winning trades, but 80-something% winning trades doesn't mean anything if you're risking, let's say, 10% of your account per trade. And at some point in time, you are absolutely guaranteed beyond any shadow of a doubt to have 4 to 5 losing trades in a row. Absolutely guaranteed beyond any shadow of a doubt. You will have 4 to 5 losing trades in a row. And if you're risking big chunks of your account on one trade, then you can quickly wipe out 40, 50, 60% of your account in a month. And you can't do that and recover, okay? That is why risk management is everything. So when I'm working one-on-one with people, we deal with the reality of your account size. We deal with the reality of your account size and how to best, which options, which ETFs to work with. Because sometimes we have to go through a list of 28 ETFs and narrow it down to only certain ones, or the best of the best that fit into your account size. There's something for everyone. There are options that cost $1. There are options that cost $15, okay? So, and everything in between. So we really work with you to narrow down, because you might be on, because you have a small account size, you can literally only trade 8 or 9 out of the 28 ETFs, and we'll focus on those 8 or 9 ETFs and nothing else. But that's, I work out with you one-on-one. That's why I like to work one-on-one with people, because not everyone wants to share their personal financial situation in a group. Okay, so it doesn't really work too well. But when I work one-on-one with you, you know, there's a little bit more sharing that goes on, then I can really help you in a better way. But yeah, to the target for this 300.48, the entry price was here at this open price, and that open was 292.21, target 300.48, and this trade is still in progress. We are still below the entry price, so this is opportunity for some people who are already in it. Just hang on. We're still in a massive uptrend, so stay tuned. It's chopping sideways, but heading up again. And the end of year seasonal pattern is still in play. So everything is looking really good for this trade to the upside. And this trade actually happened right within the scope of what we had gone over the last month, where we expect 97% of the long trades to hit the first target. That happened within the time period we reviewed last. That trade is within that time period, within that chart I showed you, the seasonal chart, where 97% of the long trades reach their first target. So getting in at a better price than expected, cha-ching. This could be a nice profit. For those people I'm coaching who are not already in this, take a look at it, see if it fits within your financial reality, because you can get in at a better price. So instead of having, if you got in at the open, your target would be the $8.27. But if you got in, let's say 5 points lower, then your target could be $13 rather than $8, because you're getting in lower. So now your first target is now $13 rather than $8. So now you have a bigger profit potential. The biggest profitable trades are the ones where you get in at a better price than expected. So now you can actually have a bigger target than expected. So your profit at the first target go up significantly, where you might have been expecting a 15, 20, 25% return to first target. Now you're expecting a 40, 50, 60% return at the first target, because instead of having an 8-point target, you now have a 13-point target. Okay. Once again, stop me, ask any questions you want. There's a lot of stuff I'm going over here. So, like I said, when we work one-on-one, I will give you all these charts already set up, whether it's for NinjaTrader, which is what you're looking at, or Thinkorswim. I will have all those charts ready for you to go. And we get right into it. If you're a newbie trader, I work with brand new traders who have never seen an option before, have no idea what anything is. I work with them from literally hand-holding them to get their accounts open, to people who have been trading for a while but just really need some help to get consistent profitability. So I have the full range of people who I work with one-on-one. But the main thing is you have to follow the plan and trust me, trust the methodology, and give it at least 3 to 9 months. It takes 3 to 6 months just to get a flow and get into a groove. And then after 6 months, you really understand the ups and downs. And then once you get consistent, then you can start increasing the amount you risk per trade. And then it starts to it's just nice. It's a nice way to trade where you can be very confident. You don't have to be up at 6:30 in the morning unless you want to be. If you want to be up when the market opens, great. But you don't have to be up when the market opens. That's the good thing. I'll show you how to do that also. Like this trade here, for instance, if you were up at the market when the market opened the next day, you're getting in at the 292 strike. If you're up a couple hours later, you're getting in at 289 strike. A couple hours later, you get a 287 strike, or you get it the next day, or the next day, or the next day. Same trade, as long as you're at or below the open and the target hasn't been reached yet, trades. And so it's very relaxed trading. You don't stress over it. If it's already open, some people like to get it over with, get the next day it opened, it's done, then they go about their lives, great. But what you would do here, you buy your option, first strike in the money, let's say the 292 call, and you place an order, a contingent order that says, sell my option contract, sell my call option when QQQ is equal to or greater than 300.48. Good till canceled. That's it. There's no sitting in front of the computer looking at stuff going up and down. This is not day trading. Okay, you don't sit there for hours. You just get your order filled, put in your exit order, go live your life. If it takes a week to get there, great. If it takes a month to get there, great. You don't dictate when the market moves. All you do is you just have your stacks. You know it's going to be 87, 90 something % chance it will get there before the option expires worthless. How much is going to be, how quickly it gets there will determine how much you actually make. Any questions so far? All right, remember, ask anything you want. What's a good amount to start with? Realistically, the absolute minimum you can even consider that you can work with without stressing out is about 10 to 15,000. 10 to 15,000 is the absolute minimum I'd even contemplate working with, because you need to place a certain number of trades. So 10 to 15,000 is the absolute low end that I can tell you and be able to work with you to be able to take trades. And that's only with 10 to 15 grand, that's only a limited number of ETFs. In an ideal world, 25,000 would be perfect to work with, or 25,000 plus. But 10 to 15 would be the absolute minimum that I can work with anyone to be able to place live trades and have enough, because you have to be able to place a certain number of trades each month for the numbers to work out. So you have to have enough capital to do that. And then if the market goes against you, got to be able to place trades the next direction in the opposite, whether it's calls or puts. You got to be able to be ready to go. So you always have to have enough capital. 10 to 15 minimum, 25 ideal to start with. All right. So I am going to actually switch over to show you what kind of, some people don't really know how money is made. They've seen option trading, but how is the money made? Sounds kind of funny, but it's true. So something some of you have seen before. One of the gentlemen I was working with a couple of years ago was so proud of his trades. He made his live trades public, once again, October through April. So it's, it's going to be good. And these numbers haven't really changed over the years. It's pretty much the same, whether you're trading now or years ago. It's all the same. It doesn't really change. So the percent returns is what we look at. On the long side, he risked about $2,000 per trade. On the long, he risked around $1,000 per trade, 1% of the account. He only risked 1% because he's just getting started. This is when he was getting started, because he followed what I told him to do. 1% of the account on the long side, and on the short side, he risked 0.5 to 1%, so $500 to $1,000 on the short side on puts, in most cases. So this was his very first trade with 106% return. This was literally his very first trade he did with me. He was like, woohoo! All right, timing was perfect. Long trade in October. So, but here's what to look at: percent returns, okay? And not a whole lot of losses. So this is October, percent returns. If something is meant to be a 10% return, it's a 10% return. If it's meant to be a 90% return, it'll be a 90% return. If it's meant to be a 1% return, it'll be a 1% return. We do not dictate to the market what we feel it's obligated to give us. I know some people think like that. All I want, the market doesn't care what you want. We have to position ourselves in a way to capitalize on whatever the market is willing to give us, and then we take it. But we don't dictate to the market. It doesn't work like that. So your mindset has to be position ourselves to make money. Whatever the market is going to give us, we're going to take it. All right. So percentage returns, a 1.2% return When I saw him doing stuff like this, I know he's got it, because he literally knows that if that's the way the trade worked out, that's the way the trade worked out. There are people who would be like, well, it's not enough, I want to hold it for, no, that is the outcome of the trade. That's the outcome of the trade, because you start messing with the positions, with the stops, so on and so forth. You impose your own personal stuff on an objective system, you're going to turn a win into a loss, and you're going to wipe out a month's worth of profits with one or two bad decisions. So one full loss can wipe out a month's worth of profits. Okay, so just kept trading all these, this, whether it's puts or calls, but look at the percentage returns, is very consistent, consistently pulling in profits. This is, I love this, minus 1.8% return. I literally know people, there might even be one or two on the meetup right now, who were down a little bit on a position, and they decided, well, I'm just going to hold it till it gets positive. And they end up turning a negative 1 or 2% loss into 100% loss. They never got positive. Okay. If it's meant to be a small loss, it's a small loss, because when you start messing with it, you can allow a small loss to become a full loss, and it wipes out, once again, a month's worth of good trading. Now you need 4 to 6 more trades to make up for it because of one bad decision. So remember, this is 1% of the account risk. The goal is 2%. Just very concerned. Anyone who wants a copy of this, just email me. My email is on the handout and on the website, the contact sheet page on the website. Just message me on there. Send you a copy of this. Here's one full loss. This is what October through April trading looks like every year, almost. It's just a lot of winning trades. Once again, a small loss. And these are all impacted by time decay. That's why they vary, but you'll notice you don't see a whole lot of negatives because of the implied volatility thing with ETFs. If it was stocks, we'd have a whole lot more small losses with negatives because of the implied volatility crush. But with the ETFs, we don't have to deal with that. That is why we can just buy calls and puts with the ETFs and have good profitable trades. And sometimes when we have gaps, oh man, gaps are beautiful for our trades, because we had some of those in the last couple of weeks. What would normally be like I said, a 10, 15, 20% return, all of a sudden becomes a 30, 40, 50% return because it gapped. Okay, so gaps are great. All right, so kept going. After 7 months, here was his return. And this is like godlike trading, okay? You can't maintain this. So when it was all said and done, when everything averaged out over the next few months, it came down to about a 5-to-1 return. Profit P&L ratio was about 5-to-1, which means he was making $5 for every $1 lost. What I've seen, and the only way to know it is by asking the professionals involved. They'll do presentations. Some of them, the ones who represent like big institutions, they'll do a presentation on trading, and they will talk about it based upon funds that they manage sometimes. And they'll tell you that, and if you dig right in, even some of the people who day trade or other trading, they'll tell you if you push them a little bit, they make about $1.20 to $1.30 for every $1 they lose. Not $5 for every $1 you lose, $1.20 to $1.30 for every $1 that they lose. They make a lot of money because they're managing billions. That's how they make money. They have they don't make 5-to-1. That's ridiculous. We can do that trading. They can't do that. Those big funds can't do that. They can't do what we can do. Okay, that's the benefit of us trading options. We can do this and they can't. So when I tell you about billions of dollars they make, they're making $1.2, $1.3 for every $1 they lose. But multiply that by billions of dollars. And for the people who think that they're going to quadruple, double, quadruple, triple their money because they hear reports of a fund making, 100, let's say $10 billion they made, some fund. They didn't make $10 billion because they had 5 billion and doubled it. They made 10 billion because they had 50 to 100 billion under management and made a 10 to 20% return. That's how they made 10 billion. They made 10 billion because they got a 10 to 20% return on the money they were managing. Okay. They didn't start with half that amount and double it. That's not realistic. All right. So trading is a whole different deal, and we have a certain advantage with options where we can do this. This is 1% of the account risk. I told you the goal is 2%. If this was a 2% account risk, this would be 34,000. If you go crazy and you go 3%, then triple that. And so that's how the numbers kind of work out. But this is a time of year, I said October through April, and your goal is going to be 10 to 15 trades a month. If you get in 10 to 15 trades a month, that's ideal sweet spot to get the numbers you need to be able to duplicate results like this. Because you got to get in enough trades to actually make it statistically worthwhile. You need a certain number of trades. Okay, so question is, which of these ETFs qualify for 1256? These are not futures. These are regular ETFs, just like stocks. And the 1256 is for Forex, is for futures, and maybe for like the SPX or something, options. These are not 1256, none of them. It's just like trading regular stocks, except and when I'm trading, my focus is not taxes. My focus is making money. I don't care about taxes. I care about making money. If you're in a corporate structure like myself and Becky trade, there are ways to minimize your tax liability by trading it in a business structure. If you're trading it as an individual, then you are pretty limited as far as tax write-offs, so on and so forth. But we trade in a business structure, so we have a lot more write-offs to reduce our tax liabilities. So you don't even think about taxes. You think about making money, and your business structure will dictate what you can do with taxes, because trading in a business structure, corporation, LLC, it really helps a lot. You really get a lot of benefits from doing that. A lot of things you can write off against it. All right, so this is what that looks like. Any questions so far on anything? I see Gloria. Other than the stop loss and take profit, is there anything else that would invalidate a trade in the example you went over today? No, it's just once you get a valid setup, trigger matches what's in a trading plan, then what could invalidate it is if the option costs too much. Sometimes it's usually more on the bearish trades because volatility has been going up. So it's usually more on the bearish trades where that becomes an issue, but not really. It's in the time, sometimes the option, let's say you have to go out 2 expiration cycles to find an option, but there are no options 2 expiration cycles out because they haven't been created yet. You go out 3 expiration cycles, no options. The next available option, which is at least 2 expiration cycles, is 4 cycles out. That's 4 months. And that option just costs way too much, because you need at least 2 expiration cycles, but the closest one that's at least 2 is 4 months out, costs too much. So you got to pass. So that would be something that would invalidate a trade. Option just plain old costs too much. I'm going to show you one more thing I want to share right now. Let's see. Stats. Okay. So again, these are the sectors we trade. This is an example. This is not the strategy we went over today, but it's one of the strategies for long and short trades, which we trade. You'll see it in the spreadsheets, the T-line buy, T-line sell. These are the stats for one expiration cycle, basically 1 month. These are stats for two expiration cycles, 2 months. If it's in light blue, it means that it's 87% wins or higher. So you can see the more time we give it, the higher the win-loss percentage goes, okay? So usually more time is better, but you pay extra money for the premium to buy more time. So the trade-off, there's a higher upfront cost, but a much higher probability that you won't have a loss. So this is where a lot of the people who I work with, they choose to trade two expiration cycles. Even if one's okay at 88%, they'd rather go two for 90% because they don't want losses. Okay, so a lot of people I work with would rather go two expiration cycles. Some people who have smaller accounts, they'll choose one expiration cycle because it's usually a little bit cheaper and they have a smaller account. So with that dictates your decision making also, how big your account is. But this is the long side for this strategy. You can see how many are in light blue. So if we got XOP, which is oil producers, valid for this particular strategy, we would pass because it is under 84%, 83. So it's below 84, we pass. If we got XRT retail with this particular strategy long, we're going to pass because it's under 84%. If we got XLI, which is Dow Jones Industrials, we would consider it. All right. T-line, this is a short side. The ones in light blue are the ones we would consider if we got a valid sell signal with this strategy. D-hook. All these are valid, are good with two expiration cycles. There's an 8-point difference, 8% difference with more time. More time makes a difference. One that never had a loss. It might have changed. This is a little bit older stats, might have changed since, but there's a significant difference going with more time. More time makes a difference. Question, is the two expiration cycle column better because of slower decay? It's better because you have more time to be right. More time to be right before, because if you have, remember, options will expire worthless. But if you have more time, you have, it might, a lot of these will literally happen, hit the target a week after one expiration cycle. So if you chose one expiration cycle, you just had a full loss. But you have a two expiration cycles, you have a win because it needed one more week. So our sweet spot is two expiration cycles. That's our sweet spot. We have the one expiration cycle option percentage. That is a business decision you have to make for yourself. Okay, that's a business decision. You have but the two expiration cycles is really the sweet spot. So Ichimoku hook. This is the one we buy market bottoms. This is the one we've traded the longest of any strategy we have. This is one we've had more than forever. This is for market bottoms. And I'll show you some of those in a little bit. And this is for market tops. This is the one where we find market tops. These have been in play the last, so this is the ETF squeeze, ETF sell, and the Ichimoku hook buy. So to show you how that's played out recently, I'll show you some of the recent stuff for that. I'll change the share, because that's been what's really been in play recently. Bottoms and tops. So let's take a look at, these are the trades, all the trades. These are all the recent trades that have already hit the first target over the last couple of weeks. Ichimoku hook. We have been looking for that because this is the one for market bottom. So after the market was going down, 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 down for weeks, we were just slowly waiting for our buy signals. And we got our Ichimoku hooks on so many things. So this Ichimoku hook is usually the very first buy signal that we get after the market's been dropping. Then we see our buy signal. It's one of our longest, like I said, one of the strategies we traded the longest, most reliable for finding market bottoms. is the Ichimoku hook, and also the crossover, the downstream crossover, which we went over today. You see that happen around the same time as Ichimoku hooks. So between the hooks and the crossovers, we catch all the buy signals at the bottom. Okay. And then we catch all the market tops with the ETF squeeze. So all these are sell signals, sell signals, sell signals. All these sell signals we caught over the last couple of, lot of sell signals. Okay, but now it's all long. Everything's been long the last few weeks, but we caught that bottom with the Ichimoku hook. That is what we use for market bottom. So when it comes up, cha-ching. We just wait for it, okay, and make sure everyone knew that we got a hook. This is get long now. This is the time. But I teach you how to see those strategies and how to capitalize on them. So the only one I showed during the presentation is the crossover, but it's a grouping of 6 strategies you trade together. Find market tops, short it, find market bottoms, buy it, and the Donchians are everything in the middle for the T-line buy and sell are in the middle, and plus 2 other strategies. So everything we trade the tops down, bottoms up, and in the middle. And that's just how we capitalize on market movement on all those different sectors. And you can also become a specialist in certain sectors and just trade certain ones. Like I know someone, he told me only wanted to trade the Qs, nothing else. I'm like, yeah, but you're only going to have a limited number of trades. He's like, doesn't care, he just wants to trade the Qs. So if you take a go to our website, you will see on the front page, on the home page, you scroll to the bottom, you'll see a chart of the Qs for 1 year. All the trades on there was about 90-something% wins and 43 trades. That's all the person took, was just the long and short trades. That's it, on one symbol. But if you do that, then you don't have to be limited to 2% risk. You can take it up to 5, 6, 7% risk per trade. And if that's all you're trading is one thing, then it works out nicely and you guarantee it. Gives them a very nice annual return and very good positive cash flow each year with a nice percentage return on your account, being a specialist also. So you can specialize in certain sectors and only trade those sectors with these strategies as a group. But you have to trade the whole group of strategies, not just one thing. Got to trade the group to get the longs and the shorts, because when the longs are going against you, you got to be short to be making money while the market's going against you. And then when the market turns around and the shorts are going against you, you got to be in your buys in the longs and have to make money on the long side while the shorts are going against you. And it's an ongoing process. Once you're in, you're in. You just trade up, trade down, and just keep booking profits. And sometimes you're going to have 15 trades open at the same time, and every single one's going against you, and you're going to be cussing me out quietly or not so quietly, and you're going to be calling it not working. The strategy stop. I just have a talk to bring you down, relax. That's why you need 3 to 6 months to see the strategies work. And if you got 15, 20 trades going against you all at the same time, it will happen, definitely will happen. Eventually, 87% of those trades will end up hitting the first target. And it just does. But you have to trust the process, trust the methodology, trust the stats, and allow at least 3 to 6 months to see it work, to see how the numbers work out and deal with circumstances as they come up. I'm going to switch back here. The question, you're able to share a copy of the PDF. The probability of profit with the different strategies, those are not current. Those, the PDF, I can send you a copy of the PDF, email me later. The percent probability of with the different strategies, that is in a trading plan that goes out to our coaching clients. I can send you a copy of the PDF with the trade history, and I can send you a copy of all the different spreadsheets you see here today, like this one with these numbers. So just email me. I can send you this spreadsheet also with this trade history. And there's a bigger version of this on the website also, but yes, email me. I can send you what we're looking at right now, Gloria. And you have my email on the handout, or you can contact me with the contact form on our website. And I'll get that to you. All right, so I'm going to go back to the handout because we're going to start wrapping this up, because we can basically do this for hours. When we had these live, we would meet live and we do a 3-hour, was it either 2 or I think it was like a 3-hour meeting we used to have live, and then people would hang around for another couple of hours after that. So these can go for a while, realistically speaking. Let's see, this one I'm sharing. Okay. So yeah, we can go through this stuff indefinitely with all different strategies, but for those people who are interested in working with me on these strategies, now is the best, literally, like I said, now is the best time, because it's October through April. If you have some experience with options, that's even better. The cost is $17.50. Anyone on a meetup today, I'll take $100 off this for $16.50, and is going to be going through the various strategies. And it's all one-on-one. And whether you want to meet in person, which is ideal, I'm in Santa Clara, California, and we can meet down here in Santa Clara if you can make it here. Otherwise, we'll meet via Zoom. But we try to get up and running as quickly as possible, since things are in play right now. We want to timing is crucial to get going as quickly as possible, because the markets are moving and that end of year pattern is developing. So we want to try to capitalize on the long side or even short side. We have both sides happening right now, but we want to try to capitalize as much as possible during this time period. And then we deal with the rest later on. But this is a time period, like I said, we have the best probability of trends. So it's not just first targets, but bigger moves beyond the first target is this time of year, whether it's up or down. We might have a big move up or a big move down, but it's usually bigger moves in one direction at the end of the year and the beginning of the year. So I review your trades with you each night. I also email you a copy of the trades which we found to be valid candidates. I expect you to do your review also, but you can compare what you found to what we found. And that is free, at least for the first 3 to 6 months. If you want that to continue, then there's a small cost, monthly of $49.95 if you want me to send you those consistently afterwards. Otherwise, but for the first 3 to 6 months, I email you those every night, so you can take a look at those and get up to speed as quickly as possible. I'd like to do a monthly review of you on your losses and wins, so make sure that what you're doing is correct. There's a lot of ways to mess up little things, make little errors, so we try to get rid of all those little errors in the first full month of trading. Things will happen. You're going to sell when you should buy. You're going to buy when you should sell. You're going to be doing wrong strikes. Things will come up. You're going to get bad executions. You're going to wonder what just happened. So as all those things come up, we deal with them. It's usually 1 to 2 hours for each session we meet, whether it's in person or online. In person, usually 2 to 3 hours in person, 1 to 2 hours on Zoom, or as much as you can handle. And I'm fairly flexible on weekday afternoons and evenings and Sundays. I do not coach on Saturday. Saturday is my time to go train in Brazilian Jiu-Jitsu and do other things and sleep. So Saturdays I sleep in, and then I go train in Jiu-Jitsu. So that's my Saturdays. Sunday mornings, kickboxing, parkour, and Jiu-Jitsu. And so I'll coach people after 2 o'clock or 3 o'clock on Sunday after when I'm done with my own training. So that's usually the way my weekends work out. So if you try to meet with me on a Sunday morning, 8 ain't happening. Kickboxing, parkour, and Jiu-Jitsu. And that's all one-on-one. If you have zero experience or you want to do the full package with the weekly programs, also weekly chart programs, that's more. Some people upgrade to this eventually, and those people who want to do that will take $400 off this price, but that's for the daily chart strategies, weekly chart strategies, at market internal. So there's a lot more involved. It'll take a longer learning curve with time, but we get it all in there over several months. But the basic is going to be this one, $17.50. Like I said, timing is crucial to go now so we can capitalize as much as possible. So let me know before the end of the week, because I am free during the holiday weekend, so I'm not going anywhere. So it's actually a good time to actually meet. And we can work on getting these strategies going and trading live as quickly as possible. Just call me, email me, go to my website. Here is the contact page. Should be seeing. You just fill the form out on the contact page to get in touch with me. On the valid trades win loss, you have the handouts, which we have today. Here is a spreadsheet with all the trades over the last couple of years. The ones I showed today, those were specially put together by Becky for this presentation. It's a subset of the big listing. If you want the ones I showed today with all the trades and all the trades 84% or higher from October through April, email me directly, contact me directly through the form. I can send that particular spreadsheet to you. Okay. On the home page, there's one recording of one of our options workshops, give you a feel for what we do. It's similar to today. And this is the chart I was talking about, the NASDAQ in 2020 with all the different trades identified. And it comes out to 41 trades and 3 losses. Okay. But that's kind of what it looks like when we specialize on one ETF or one market. It's literally like this. That's why that's how we trade options. Right. And you can see that nice 40 period moving average there. Okay, that's beautiful. But it works extremely well. So, and we also have on the page, the coaching programs are also here too, the same ones that's in the handouts. This one's futures. We've been on futures for a while, maybe in December, but this will be in January. This will be our last meetup for this year. And if you guys can also message me, is there anything, particular topics you want to go over for 2023 that I'm able to do, we can go over that. So let me know about that also. And if you want to work with me on the options, please contact me as soon as possible. Like I said, it's before the end of the week is ideal. And take $100 off the $1,750. Do you recommend 25K to start on futures as well? On futures, I would recommend, it depends if you have experience with futures. It's for the way we do futures is a little bit more technical analysis. And whether you want to focus on index futures, currency futures, or both. The last couple of years, if you look at all the trades on index futures and currency futures, it was a 40% return annual, 50% return annual, 60% return annual. This year, we're looking at about a -10, -15% return. So this was our off year, which doesn't happen very often. But we're looking at 20K would be a good amount to start with. And you can, with the futures, we trade the micro futures. So you don't have to go really big. You don't need as big an account. So 20 grand would be fine to work with, and you wouldn't be risking anywhere near that amount. You don't risk anywhere near that amount. You can actually go a lot more conservative with the futures. It just requires more technical analysis, but you can go a lot more conservative with the futures and not have to take any big risks. But 25 grand would be perfect, but keeping your risk pretty limited. All right, once again, no big losses allowed. No more than 1 to 2% of account risk. All right, so let's go ahead and wrap it up unless you have any questions, but you can also always email me, call me, anything. If you want to talk about your particular situation and your reality, let's set up a time to chat, because everyone's different. I may not be the perfect person to work with you, but we won't know that till we chat one-on-one, and then maybe I can point you in the right direction. But I want to make sure people have realistic expectations. You don't just go trade and get rich. It's not an overnight thing. This is a process. It's a business, and a business takes time to develop, nurture, and make it your own. And you got to find that sweet spot that works for you. All right, go ahead and wrap it up now. And our next meetup will be in January, but I'll be talking to anyone who needs to talk between now and then, and setting up meetings, and whatever you need from me, just call me or email me, and I can help you out. And I don't put a limit on coaching times either. The coaching says 6 months. I don't cut you off after a certain amount of time. It's like, if you need help, there are people who work with me for like months, for years, and they call me and need help, no problem. The people who've been emailing me literally every single day to verify their trades are correct for the last 13, 14 years. They've been emailing me every day. I'm like, cool, yeah, I'll check it out. It looks good. All right, talk to you guys soon then. And you all have a good holiday, and talk to you soon.